Thank you very much. Thank you so much for joining. Today, we have lined up for you leading representatives of the Value Partners investment team, which in my opinion is one of the best investment teams of its kind in the world. So in this team, we have 70 people, analysts, fund managers, dealers, out of a total staff strength in Value Partners of about 230 people. Now, the first point I want to make is that I've been doing investment now for something like 30 years, and I still think investment is an art. It's not a science. As a dedicated value investor for more than a quarter century, I'm still doing the same thing I did in the beginning. I'm buying the 3 R's: the right business, run by the right people, at the right price. But as you shall see, the relative importance of each of these 3 R's has been changing in line with the changing investment climate. And I also want to clearly state that although you may have read in the media that value investing is out of fashion, it doesn't work, etc., in fact, our performance remains consistently strong. In the year of 2020, our flagship classic fund delivered a gain net of 38% to investors, whereas its benchmark Hang Seng Index was up just 0.2%. And there were other funds in our group that performed even better. For example, the A-Share Innovation Fund returned 89% in 2020 against a benchmark gain of 38%. The Chinese Mainland Focus Fund returned 74% against a benchmark 29.5%. Looking at it on the long-term basis, which is in fact more important than a year-by-year performance, the long-term record of the flagship classic fund is still excellent. Since inception in April 1993, classic fund has delivered an annualized return of 18% per annum, compounded over 27 years. That's 18% return per annum compounded over 27 years, compared to the benchmark gain of 7.5% return over the same period per annum. And this is not a small fund. The fund size classic is about 1.4 billion US dollars, slightly over that. Now, I think to get into this discussion about what works and what doesn't, and to understand the value investing concept, is useful to break it down into the components. What are the different components of return? Essentially, there are 3 components of return for a stock market investor, at least in Hong Kong. The first is increase in earnings per share. If nothing else changes, and if the company is able to increase its per share earnings by 10%, the share price will in fact increase by 10% as well. In Hong Kong, we had a good dividend yield that is tax-free, no tax on dividends. And if, for example, the dividend yield is 3%, you have an additional 3% on top of that 10% I just mentioned. The last component of return is increase or decrease in the price earnings multiple. And I'll come to that shortly. I want to first start by explaining that throughout the 1990s, those of you who may have known our fund well at that time, our fund was able to generate quite consistently stable returns of roughly 15% per annum. And if you look at the record, it's quite clear that 10% came from increase in earnings per share, and 5% came from dividend yield. So 10 plus 5 was 15. Throughout most of the 1990s, the price-earning ratio of our portfolio was quite stable. So it was not an important component. But how things have changed. In fact, today, ever since the global financial crisis 2008, the most important variable in the return was change in PER, price earnings ratio. That is what you really look for now. So as I mentioned, the third R, earnings multiple, is now the most important variable. Let's clarify quickly what is meant by PER. Price earnings ratio is simply the share price divided by the earnings per share. It simply measures how much an investor is willing to pay for per dollar of earnings. So if your PE ratio of a stock increases, for example, from 10 to 15, the stock price will increase by 50%, by 50%. That's a lot more powerful than 10% earnings increase, or in today's world, 2% dividend yield. That's why investors now pay a lot of attention to PE, to multiples. So the concept is changing from simple value investing to what Value Partners team calls quality value investing. Quality value investing emphasizes the second and the third R that I mentioned, trying to find the right business, the right brand, and the right people, rather than focus too much on the right price. So what we do is we are trying to find stocks where they are catalysts that will allow the PE ratio, the PE multiple, to go up. And this is more of an art than a science. It requires a lot of research. That's why I started out by mentioning that we actually have 70 people in our investment team. You are basically being asked to make a lot of qualitative judgments. The way I see it is like you are like a judge in a court of law. You are doing what they call balanced probability evaluation, whether the guy is innocent or guilty. So whether the stock is a buy or not a buy. You have to carefully weigh up various factors based on your research and information available on whether the stock you're looking at represents a superior business with durable advantages. I will elaborate more later. But I just give you a quick example to try to summarize what I mean. So here I have an example of a company listed in Shanghai that is involved in solar energy. And you will see that this company's share price went up by 112% over 6 months. That's updated to yesterday. 112% in 6 months. And what's driving it basically is that investors are much more willing to pay a higher multiple for each dollar of earnings in this company. In fact, during this period, the earnings and dividend of the company were quite boring, very average, but the price earning multiple reached a high of 78 times earnings from 36 times earnings just 6 months ago. The catalyst in this case was a commitment by the People's Republic of China to have a carbon neutral economy by 2060, if I remember. Meaning to say, the Chinese government wanted to emphasize clean energy, and this company is of course a leader in the use of the sun's energy for power. So investors just love it. So here you are, earnings per share, not too great. Dividend for this company is frankly just above zero, but the PE multiple was able to more than double in just 6 months. This is a beautiful example of, and to arrive at the buy decision, my team and I, we had to carefully make a lot of judgment on the characteristics of the company, its business model, its management quality, the fundamental characteristics of the whole industry, and the how seriously to take the government's commitment to emphasize clean energy, and what does it actually mean in terms of translating into medium to long-term growth for this particular company. So far, we got it right. Now, I want to talk about the concept of quality value investing and extend the concept from simple stock analysis to a global landscape. We, in my view, need to use this concept not only to look at individual stocks, but look at entire asset classes and countries. Today, across the world, we face a deteriorating investment environment arising from quite a lot of factors that you probably see in the media, including market bubbles, distorted valuations, and a breakdown of rational economics. In the markets today, we don't really have too much of a free market anymore in many parts of the world. Instead, the key market actors have become governments and central banks, and a key part of their policy is actually wealth distribution. So there is, in fact, not only a potential for PE multiple re-rating up, but potential at the risk of PE multiple de-rating down. So consequently, if a PE multiple were to drop from, say, 10 times, or from 20 times PE to 10 times, your stock price would drop 50%. So you also need to watch out for that. So quality value investing not only applies to actual companies, but I think it should also be used as a tool to evaluate entire markets and countries. I really worry, in fact, about what I call a gathering storm, question mark. The growing risks arising from the global phenomenon of social unrest, populist politics, massive borrowings, and currency debasement of currencies. And so here, I just want to strongly emphasize that China still offers a potential for PE multiple re-rating. Is simply stronger politically and in terms of social stability, financial discipline, and market opening, and continuing to pursue engagement with globalization. The Chinese economy is set to contribute 30% of global growth for years to come, in the context also of an appreciating currency. So in a troubled world, I think China offers a quality value opportunity. It is time now for me to summarize. I would say that in the 1990s, our basic investment style as a value investor was simply to buy low, sell high. I think this particular style has lost its competitive advantage because today's world, information is widely available, and there's an oversupply of over-educated investment professionals who know how to crunch numbers and set out financial modeling and financial formulas just as well as we do. So we lost our advantage. In the 1990s, even getting annual reports required a major project. But today, using the internet, you can get access to any kind of financial information, so long as it's public, very easily. So a strategy based on number crunching and finding cheap stocks is very hard to gain an advantage over others. Today's style, I would summarize to say, buy right, sit tight. What I mean by that is, you have to exercise judgment to select superior brands, superior businesses, and you have to exercise your good judgment based on very good research to go into the right markets and countries and consider not only the purely financial numbers and factors and business models, but also the economic, social, and political dimensions of the country and asset class you are getting into.